with Indigo, Dr. Lal Path Labs, and even something like an Alchem Labs. So what about 2016? V. Jayasankar, Senior Executive Director and Head of Equity Capital Markets at Kotak Investment Banking, now joins in. Jayasankar, good morning. So what, we had $17 billion of issuances in 2015, 5-year highs. In 2016, does it go up to what, 25, 30? Are we looking at a really healthy pipeline?
Yeah, sure. So 2015, as you said, has been a big year for the IPO markets, and we expect 2016 to be even better. If you look at the pipeline currently, it's across some of the very interesting sectors like consumer, IT, banking, financial services, and a lot of the companies which are essentially a play on the consumption story. So given this, and given that we are seeing a structurally strong capital market for the next 2 to 3 years, I feel very optimistic about 2016.
Okay. Jayasankar, hi. Good to see you in this afternoon. Well, I just had one point to play the devil's advocate when it comes to the IPO market. Since I look at the healthcare space, I wanted to quiz you about specifically about Dr. Lal's as well as something like a Narayana Healthcare, where both the stocks had more of a concept story which was attached to it, and hence there was no regard for the valuations that both these companies saw, and in terms of even the subscription that we saw, and even for the listing that we saw for Dr. Lal's. Is that a theme that we can see play out for many more IPOs to come? That yes, if it's a unique concept story, valuations will be disregarded?
Yeah, so I can comment about Dr. Lal since we are directly involved.
Okay.
See, we saw very, very strong demand from both the FIIs as well as the domestic institutional investors. For a simple reason, as you rightly said, it's a very unique story in the healthcare space. What investors really liked about Dr. Lal was the fact that it was a strong consumer brand in the healthcare space, which is expected to grow probably as an industry at around 16%. And Dr. Lal was very strongly positioned to really get a larger share of that growth. So as a result of that, as well as the fact that the company's financial performance historically has been pretty strong, with very, very good growth rates, strong return ratios, we saw investors willing to pay the kind of valuation that you ultimately saw. And finally, when you look at where the stock is trading, it's probably about 45–50% higher than where the IPO got priced. You're seeing a scarcity premium getting built into the overall valuation. And we have seen in the past that when unique stories come to the market, often this scarcity premium gets built in and sustains over a longer term.
Sure. Okay, so Jayasankar, let's talk about the 2016 pipeline. The big one that I'll be watching out for would be the Vodafone IPO, clearly. But, what would be 3 or 4 big ones to watch out for?
See, 2016, you're going to see a very good mix of medium and small size IPOs and perhaps a few large IPOs. Difficult to really comment on individual companies because for compliance reasons, one, I can't really talk about companies where we are working actively and if the prospectus is not yet filed with SEBI. And there are companies that are still talking about doing IPO, just like you talked about Vodafone. So without really getting to the specifics, what I can certainly say is that 2016 is likely to see a much larger IPO flow as compared to about 14,000 crores raised in 2015. Our expectation is even bigger. Based on documents that's already filed with SEBI, I think there are probably about 20 odd documents. You see a good mix of companies raising well over 1,000 crores and a good mix of companies raising under 1,000 crores.
What about startups and digital companies, Jayasankar?
Startups, digital companies, particularly from the e-commerce space, I think will take a longer time to come to the market because the first thing that any of these startups or e-commerce companies have to demonstrate for public markets is path to EBITDA profitability. And all these companies are currently focused on market share, currently focused on customer acquisition, which is probably the right thing. And the private investors are very happy backing these companies so that they gain the right market share, gain their strong dominant positioning, and therefore there's a lot less focus on the EBITDA levels. So I think it'll probably play out this way for some more time, and therefore startups and e-commerce may take a little longer to really come to the market. However, having said that, I think there'll be a couple of exceptions to this because there are companies which probably have achieved the right level of EBITDA profitability.
Okay, well, just hold that thought, Jayasankar. Some news on United Spirits where they have possibly told the exchanges that the net worth erosion in FY15 was due to exceptional and non-reoccurring items. Remember, there is an EGM which is going to take place on the 22nd of Jan, where they're going to report to the BIFR in order to get protection, considering the net worth erosion that they've seen in the company in the past 4 years. So those are the statements which are coming in from United Spirits at this point. Jayasankar, I just wanted to take Anuj's point forward, because one thing which has really intrigued me is around $8.5 billion in terms of investments in startups, not listed, but still over 1,000 startups received a ridiculous amount of money in terms of investments in 2015. Do you think that at some point in time is possibly not going to go in return, or they're probably not going to get the returns that they anticipated? Or do you anticipate further sort of investments in 2016 as heady as what we've seen in 2015?
See, I see many of these startups and e-commerce companies continue to tap money from the private markets for the simple reason, as I mentioned earlier, the focus is on customer acquisition, the focus is on building dominant positions, and a lot less on path to EBITDA profitability. And these private investors are very patient investors who will probably keep pumping in money with a 3 to 5 year perspective, and that's not the way the private markets look at, the public markets look at. And therefore, from a IPO standpoint, I think many of these companies will clearly prefer the private markets as compared to the public markets. And as I said, there are a couple of exceptions to this because there are a couple of companies which probably have a better visibility and predictability about EBITDA, and therefore those companies will probably look at timing an IPO perhaps in the next 1 year.
Okay. All right, fair enough, Jayasankar. We're going to leave it on that note. Thank you very much for joining in and wish you a happy 2016 as well. Well, on that note, we're going to wrap up Trading Hour, but stay tuned. Halftime Report is up next, and the next time Anuj and me and the entire team join you will be in 2016.